Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Peter Boockvar and Ira Harris. Peter is the Chief Investment Officer for the Bleakley Financial Group and Advisory at Bleakley, and he has a newsletter product called the Book Report, BOOCK report.com. It offers great macroeconomic insight and perspective with lots of updates on economic indicators. And Ira is independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also a CME director from 1997 to 2003, and also most recently. Welcome, gentlemen.
Thank you, Rich. For having us. We're glad to be here. Peter, it's wonderful. And
always, Ira. Thanks.
Yep.
Great. I thought we'd begin with a discussion of this week, the Federal Reserve statement and the question and answer period. What do you guys make of what happened this week? Peter?
So I think that yesterday was sort of a follow-up to what Powell told us it was a follow-up to all year the new concept of inflation symmetry, which has been talked about in every single FOMC statement this year, symmetry being above and below and around the 2% inflation target that they have. Then Powell gave further color to that in August at the virtual Jackson Hole conference. And then in yesterday's meeting and statement, there was more color around that. I think it's a completely incoherent policy to say that we want average inflation targeting, but then they'll only accept inflation moderately above 2. Well, what happens if you have a couple of years of zero inflation and you will only accept moderate inflation above 2? Then, are you just going to keep rates low for longer forever? Or if 1 year you have, or if let's just say you have 5 years of no inflation, are you going to accept 5 years of, you would need a lot of years of moderately above 2 to get to any average. And first of all, inflation today should be irrelevant in determining, the policy today should be irrelevant what inflation was. It should be where inflation is today. So I think that this is just economic mumbo jumbo. I think that the Fed should be more focused on the direction of the virus and the vaccine, because it's the virus that put us into the current monetary situation that we're in. Rates would not be zero if we never heard of the word COVID before. So the Fed should be more focused on the vaccine and the addressing COVID rather than some nonsense inflation targeting. So I think that they're just following the path of Yellen and Bernanke, have rates at zero, QE, negative rates, and what the Bank of Japan did, the ECB did, the BOA, and they're all like hoping for a different result. Like the Fed is maybe seeing what others have done, but they think that somehow their recipe is going to be tastier. They have all the same ingredients, but somehow Jay Powell is going to make it better, and his is going to work, even though everyone's policies have failed. The difference this time, though, is you have massive fiscal spending, where we had $3 trillion spent at the last deal out of Congress, and now we're looking at $1.5 trillion. So now we have actual debt monetization and the Fed financing all this deficit spending. So the combination is what may actually give the Fed the inflation that they want. But I've said before in my writings that if they get it, they're really not going to want it, because it's going to be a mess for global interest rates. It's going to be difficult on the consumer in a consumer-driven economy, and it can wreak havoc on markets if we do get the inflation that they're craving.
Mm-hmm. And before we get to Ira's thoughts, just wondering, what about on yield curve control? Did you hear anything or see anything in the wording? How do you think they'll approach that going forth?
Well, they're essentially doing it because they said in their projections that rates will stay at 0 for 3 years. So that's the equivalent of yield curve control, and that's the equivalent of forward guidance. But forward guidance is, and Powell said yesterday that he referred to forward guidance as a powerful, and he used the word powerful multiple times, powerful stimulus. And I argue that it's the exact opposite. And it is not stimulus, it is a depressant, because the definition of stimulus is to stimulate you to do something today that maybe you would have waited till tomorrow. So that was cash for clunkers, and that was a home buying tax credit, and that's stimulation, that's a tax cut. But by telling us that they're just going to keep rates at 0 for 3 years, well, then there's no urgency to do anything. I don't need to go out tomorrow or today to just go out and do something with that cheap money. I got 3 years to sit and wait. So it actually is a drag on growth rather than being a powerful stimulant. And all you have to do is look at the experience of Bernanke and Yellen, who kept rates at 0 for 7 years and then took another 2 years to raise rates a total of 50 basis points. And what the Bank of Japan's been doing for decades, and what the ECB's been doing for many years now, it's not powerful stimulus. It's actually a powerful depressant on growth.
Mm-hmm. And your thoughts, Ira?
Oh boy, Peter is dead right on target. And there's nobody. I was in a group afterwards trying to clarify some of the things for them, and I brought up Peter's, because he's 100% right. What Peter talks about is the inflation. And who's the inflation going to harm? The inflation is not going to harm. And I was talking to a room of traders, all pretty successful, I imagine. I don't know all of them. But I said, you people can sustain yourselves so long. The people who he's talking to, who are at, and I'm using his terminology, at the bottom of the economic ladder, who have been the first laid off, who are not going to sustain pay raises here. In fact, that's one of the things he's fighting for. But the inflation is going to come first. So Peter is right on top of this in so many ways, and that's just part of it. Now, let me pick up on that yield before we get to my other part. Here, I'm reading the sub-headlines this morning in the FT online. Global equities slip after Fed comes up short on QE plans. I wondered where these people were. See, that's the problem. And I'm going to take the media to task because they come with these preconceived questions. They don't listen. So there's nothing provoking. And it needs to be provoking because that's what your listeners want. I know what the Fed wants to tell me, but I want you to afflict them and make them uncomfortable and ask him questions that he doesn't want to answer. So they don't ask these. So okay, if the inflation comes, aren't these people going to be harmed? What are you going to do about that? And we just did here. So nothing was revealed. It was more of the same. Yes, he didn't mention yield curve control explicitly because it seems to be that is the third rail for them. They just don't want to go there officially. They'll do everything around it. They cannot go, well, we're engaging, we're going on top of it. They cannot get there. And it's really sad that they won't tell us what that plan is, because it's coming. And the two questions that needed to be asked in regards to it, okay, Peter's right. Stop looking through the rearview mirror. And by the way, Paul Volcker had the same issue with the Fed before he passed on. When was that? Last August. but he was raising that issue about how do you think you're going to hit this target so explicitly? And that's what you're hanging out for. He was very critical of it. But my first question to them, and I put it in the blog the other night, is, look, if you're in favor of inflation, do you therefore want the dollar to go lower? Now, Chair Powell, I know you don't talk about the currency, but I'm talking about monetary policy here. So if the monetary policy is having a negative effect on the dollar, you want to create inflation, shouldn't you be in favor of the dollar going much lower? And then I would have a corollary question to that, which is the corollary question would be very simple. So if the dollar goes lower and the market starts pushing long end yields higher, will that prompt you to engage officially upon yield curve control in order to control the entire panorama that you think is important for getting to inflation? Because you've told us over and over again, inflation will be secondary to getting the jobs back, especially for those who've been most harmed and who were doing very well prior to the onset of COVID. So if that's the case, we know that inflation, you're willing to tolerate significantly higher inflation. Are we not reading that right? In order to get the jobs. So let's ferret it out. And I'm sorry, I'm picking up from where Peter was, but that's where he left us. And if it's maximum unemployment and you don't have a number for maximum unemployment, why do you have a number for your inflation level? Well, of course, you've smoothed it out, because if you extend it out over 6 or 7 years, I could probably run inflation at 4 or 5% for a year and still not get to that 2% level. I'm pretty sure my math is right about that. So I don't know. I thought it was a very, very weak, and if I had to put a term on it, it was exceedingly dovish. And I think the stock markets reacted the way they did because they're more concerned about what's going on in Washington. And the markets, like the Fed, would like to see a real, $1.5 trillion new stimulus program added on before Congress adjourns. But I'll stop there.
Peter, what are your thoughts on inflation, specifically in terms of the mechanism? How do you see the mechanism of inflation working here? Is it driven by supply side disruptions or demand side? Maybe when there's a vaccine, availability comes, there's some stimulation there, or monetarily through a lower dollar. How do you see the mechanism of inflation?
So it's going to be a combination of those factors. I think right now, what we've seen so far is supply side disruptions and capacity constraints in a variety of different industries. We sort of got a dress rehearsal when we were in the middle of the pandemic, and you saw prices at the supermarket spike. The price of meat spiked because obviously a lot of things were shut down. You shut down auto factories for a couple months, so there's a dearth of inventory on dealer lots. So people are going out to buy used cars. So we have a spike in used car prices. That in the CPI number last week jumped 5.4% in 1 month alone. And you're also seeing that in cargo. So you have commercial airplanes that not only for a while took passengers, but they also shipped a lot of cargo. So now you have thousands of planes that are grounded because of the lack of traffic, and you have a lack of capacity to ship cargo. That is allowing UPS and FedEx to say that they are putting surcharges on every single package that's going to be shipped during the holiday season. So I'm expecting to see a lot more supply disruptions. Take lumber, for example. Weyerhaeuser, to use that as an example. Well, during the pandemic, they assumed that business would be off for a while. So they shut down a bunch of their plants where they take the timberlands and they sort of refine it. And, now they have a jump in demand for housing, and we've seen record prices in lumber. Prices have come off, but even with a sharp sell-off, they're still well above where they've been over the past 20 plus years. Then with all this fiscal spending that has kept the demand side of the economy much more elevated than otherwise, where to the point that with these government transfer payments, that has more than offset the lost wages and income from COVID. That has also led to a consumer spending that is now above where it was in February, and a savings rate that's double digits. So you have this crimp on supply, you have demand side that's being kept afloat and will be kept afloat further if Congress passes another $1.5 trillion plus spending bill. And then, of course, you have the Fed that is now sort of monetizing and financing all this government deficit spending. And then you throw in the weaker dollar, which I think will continue to get weak, and you have the perfect sort of mix of inflation. And I think that it's no coincidence that gold is around 2,000, that inflation expectations in the tips market has risen, that even consumers are beginning to see this because consumer inflation expectations and the confidence numbers have been elevated. And I think that this, we're already in September, so this is going to be more of an issue in 2021. But I think you have all the tinder for surprises and inflation. And then when you do get a workable vaccine, well, that will further increase the demand side on top of a crimped supply side. And it's a perfect mix for higher inflation.
Mm-hmm. And your thoughts, Ira?
I agree. I agree wholeheartedly. Everything that's there. You can't get around it. Now it's the only thing is going to be the market reaction, and so therefore I go back. They're going to be. They don't want to get there, but I know certain people don't believe in the boogeyman of bond vigilantes, but you can already see it with some of the people who are hedging out their bond exposure by buying 5 and 10-year tips, and we've seen those certainly rising. But I think you will find them, and the market will come. Now the Fed will bloody and batter them, but there is a war on the horizon between those who see what Peter sees and what myself sees, and we're seeing it. By the way, I'll come back to that. In certain equities that we discussed, I know Peter and I discussed them, Louis Gavet, we discussed these equities, and they're actually been performing very well, and they're equities that you can actually sleep on at night, pay enough of a dividend, but they're involved in capturing some of this price inflation that we've been seeing and will continue to see. So it's out there, and then the Fed will be forced into that position. They don't want to do it, but if they did, if inflation was something that they really wanted to unleash, the weaker dollar would really help. And if they actually put out yesterday, if they would have said, yes, we're going to yield curve control, the dollar would have sold off precipitously. And if you think a weaker dollar will get you higher prices, well, then shouldn't that be part of your toolkit without saying that you have a dollar strategy like every other central bank in the world? We don't have a currency strategy. That's just part of our monetary policy. But I think that's right. So coming back to that, and I think that let's take everybody wants. The Brits did it this morning too. When they look at energy, they talk about the transitory deflationary nature of the energy markets. Well, again, over time, if you go from highs to lows, energy prices look very low, but we've seen natural gas creep up here. In fact, November natural gas futures are quite a bit higher than where the expiring October contract is going to be. So there's as Peter points out, there's many things in the works here. And the Fed's going to get what they want. Now, whether the Fed gets what they want, to me, is inconsequential. I'm more concerned about what's going to be the ancillary effect from the markets, and that's what I have to concern myself with. So, being that I think that they're going to get it, I would, David Rosenberg and I and Lacey Hunt and Peter will probably, and we should probably embark upon that discussion, is why would I want to buy bonds now? okay, I understand that because of COVID, they've been a great investment this year up to a point. But will they sustain that? I'm skeptical.
On the question of a weaker dollar, will Europe and Japan and China allow that, or will they be comfortable with that, or do you see the potential for a currency war, on the currency level, Peter?
Well, the European Central Bank is already uncomfortable, and they expressed that last week. So exactly to Ira's point about the currency being an integral part of the central bank's attempt to generate higher inflation. I mean, keep in mind that the euro was 140 when Draghi says whatever it takes. So all it took, after being in a range of 105 to 115 against the dollar, for the euro to get to 118 to 120, and all of a sudden we're hearing currency worries by the ECB. I mean, it shouldn't. The move is so irrelevant to influencing the rate of inflation, but it tells you that how sensitive these central bankers are to even modest changes, because they know that, again, to Ira's point, that a weaker currency is a key component of their ability and desire to get the inflation that they want. So to your point, yes, no country is going to want to sit by and have their currency accelerate against anybody else. And even the Swiss and what we've seen there over the last couple of years can attest to that.
Yes. Yep. I agree with that. And if I can pick up first of all, the Chinese currency has been rallying strongly. It's over the last 4 or 5 months. So they're not concerned unless we put on our Michael Pettis cap and they go, we're going to shift to a heavily, we're pivoting, to use Jay Powell's favorite words. We're pivoting to a more domestic-based economy. Then currency, of course, will enrich them, as Michael Pettis has argued for quite a long time. The yen has been performing well. And you know what? It was only Philip Lane. You know what? Philip Lane needs to go back to Ireland. That was a ridiculous comment. I'm sorry, because it was just a ridiculous comment. I don't know who got into his bonnet and buzzed him, but Lagarde wanted no part of that, because I would argue that the stronger euro actually works well for Christine Lagarde, because it allows her to turn to the Germans and go, see, our policies aren't insane. And the market is rewarding us for our policies, the combination of the policies, fiscal and monetary, and they're taking our currency higher. What complaints can you possibly have? That's what I would look at it. But because this is not a trade issue at this point, as Peter says, these are minimus moves. Yes, if you take the low in the euro made in the absolute pandemonium at the onset of COVID, the move is okay from 106.5 to 120. All right. But if we really take from where we ended last year and where it sat for quite a while, here, I don't have to guess. I can go to my magic screen and look at it and go, it's 6% above its 200-week moving average. And if I go farther, it's below its 200-month moving average. So any type on a mean reversion basis, the currency has really done nothing. I don't know what all the noise is about. I find it incredible. And as Peter talked about where it was when Draghi made, July 2012. But if you go to 2008, when the United States was beginning to really reveal how severe the coming subprime lending was, how it was going to harm it, the euro was almost up to 160. So, I mean, we can play highs and lows. We can play that game all you want. I know the media loves to throw out, it's no such thing. 106.5 was an absolute panic reaction to the possibility of a threat of a dollar shortage. I mean, the last week of the year of 2019, the euro was at 112.5. This is nothing for currency moves. We've seen the real move 30, 35%. What's 4 or 5%? Philip Lane needs to go back to his hobbit hole and hide out for a while and, pretend that he doesn't know anything about the currency.
Yeah, I mean, there's a level of desperation when you start to whine about the euro going from 115 to 118 or 119. That's just reeks of desperation.
I think that's exactly well said. That reeks of desperation. And I, you know what, Christine Lagarde, I say great for her because she avoided it totally. She wasn't part of it, no part of it whatsoever. So it resided in a few people, and maybe Ireland because they do so much external EU trade, but it's it's just minimalist. Then you're speaking your own book. And how are you different than the Italians or the Spanish or anybody else, or for that matter, the Brits? You're playing the same game.
So overall, on the big picture, macro view, do you see the purchasing power of currency as being effectively sacrificed in the interest of keeping interest rates stable, in the interest of generating some inflation to reduce the burden of government debt? Peter?
Well, that's been going on for 107 years since the current Fed was created, where the value of the dollar is down 95%. So you can your dollar then can buy what a nickel can buy today. So yeah, that will just continue.
And Ira, your thoughts?
Yeah, it's again, to quote the central banks, it's just another tool in their baskets or in their toolbox. So yeah, and they don't like to speak to it. The Fed gets a free pass with that because it's the Treasury's job. It's the Treasury talks about it. It's not their job. But every other bank, and Peter has pointed this out many times, so just another one of their tools for monetary policy. That's what the Swiss, it's great that Peter brings up the Swiss because nobody does it better and they've gotten away with it. But it's all about keeping the currency. They tell you, they honestly admit it. The Aussies honestly admit that everybody's willing to step up in a minute. The Fed doesn't want, because we can't talk about it. But if it depends upon how you pose the question, whether or not they can talk about it.
Let's move to a discussion on the sectors of like agriculture. Peter, do you see a food crisis emerging in terms from supply side chain disruptions, climate change, maybe protectionist factors? Do you see that happening?
I mean, I don't necessarily want to use the word crisis, but I do see higher prices. And I think China is a factor in that. China's been a voracious buyer of U.S. ag, not because they care about the trade deal, but because they're not producing enough themselves. So you've had this nice move in soybean prices, for example, where soybeans are up about 10% over the past a month, back above 10. You have corn, which still is below $4 a bushel, but it's been trending higher. And if you look at the overall CRB food index, that has also been trending higher. That, in fact, is just a few cents from the highest level since August 2019. So I do think that ag is an attractive area, as well as a bunch of different commodities, or industrial metals, particularly copper. I think energy is very attractive, not because I'm bullish on the long-term demand side for crude oil, but I know that the supply side has been badly crimped, particularly U.S. shale, and over the last 5 years, deep water. So I think that there's going to be another run higher in crude oil, and I think natural gas is attractive as well. Then you can throw in my positive belief on gold and silver, but I think the whole commodity complex, after being sort of very much neglected over the past many years, could come more into favor as part of my overall inflation thesis.
And Ira, your thoughts?
Well, it's a very good question. We're seeing it in some of my favorite individual stock picks, and I know Peter, because Peter, when was it? Back in February? Yeah, before it all fell apart, right? But we had talked about it back then, and that was without anything really setting being set on fire. We were into the Brazilian harvest. The Brazilian had a massive harvest, and the United States is, purportedly to produce a pretty good sized crop. But I think it reflects China's needs, and China's needs are evidently bigger than we think, because the fact that I'm looking at $10.15 November soybeans right now, somebody's taking a lot of soybeans, and that's coming into what we know is going to be, I know it's a little dry in Brazil right now, but a massive planting by the Brazilian farmers. Because let me explain something to you. In terms of Brazilian reals, which Brazilian farmers ultimately receive, soybean prices are record highs, all-time highs. So there is a lot of movement of grain going on. And I think a lot of it points at China, because China cannot afford to be caught short of food, ever. That's just not something that this administration, the Xi regime administration, would want to contend with, especially with so many more people in urban areas over the last 20 years. Being caught, that is not an option. So I think there are those types of things putting upward pressure on grain prices. In fact, grain prices keep moving up. It may bode well for President Trump, because the ag sector has not been a healthy part of the economy. I think the tariffs, what I call the Ross-Navarro tariffs, were badly planned, badly timed, and hurt the American farmer dramatically. But it may be now that conditions have more to do with it. And if prices keep going up, who's to say you won't see $11, $12 beans over if the buying pressure is so great from China? Because usually the Chinese try to hide and change. They'll cancel shipments. They'll, in order to put some pressure on prices. But we haven't seen any of this. This has been a very straight move. So it bears watching. And if you think it bears watching, then you better start doing your work, especially if you're not a futures trader, but look to the ag sector to look for the best areas to partake. And I'm the two grain stocks that I watch very closely. Price movement have been quite dramatic for a company of that nature. We're not talking the FANGs or other tech stocks. These are purely commodity stocks, but they've been so unloved for so long that they may be getting some attention now, and that may be pushing the stocks as much as anything. But I think the Chinese are it's serious to watch the Chinese at this point.
Mm-hmm. And what about your thoughts, Peter, on precious metals?
Remain very bullish on precious metals as well. And you listen to Jay Powell, and it just gives you more reason to be bullish when you hear that the Fed, we've heard the Fed is not thinking about raising rates. And that was endorsed yesterday. The economic and monetary projections of the Fed funds rate being zero for the next 3 years. They're also buying $120 billion a month of treasuries and MBS. You had the Bank of England today talking about that they're investigating the effectiveness of negative interest rates. I don't think they need to do an investigation. They just have to look at the experience of the ECB and the BOJ to understand that it's a trap and actually does huge amount of damage to one's banking system. So I can't even imagine what goes through the brains of them to think that this is even a good idea. But it's this delusional mentality of, if you just keep giving more and more and more and more of the same medicine that hasn't worked, and somehow thinking that you're going to eventually get to a different result, leads you to the position that you're in. So I don't know how people don't own gold and silver. And in the context of the last 10 years, gold is just back to where it was in 2011, and silver is about 75% below where it was at the peak in 2011. So there's still more room to run.
And your thoughts, Ira?
I'm wholeheartedly, I concur with that. I think, again, they embark upon this like there's some magic elixir. There's no magic elixir. And if you look at the banking sectors, and the U.S. banking sector still can't really get up off the ground. And some people, you can watch them trade because of the algorithms all day long with whatever the yield curve does. So when the yield curve flattens, they hit the bank stocks. When it steepens a little bit, they buy them. I actually probably committed the sin of sins on what day is today? Thursday. On Tuesday, I actually bought a block of Mitsubishi Tokyo stock. I just, what, the dividend is high enough. The stock has been dead money for so long, and I said, with Abe out and Suga coming in, maybe there'll be some big consolidations and profits will return. But it's the sin of sin because I've committed money to be dead. And, I didn't buy an equity. I basically bought a bond because it's going to be collecting the dividends like clipping a coupon. But the bank stocks are just miserable, and they're all in response to central bank policy. It's just part of it. Bondholders and banks are the suckers in the game right now. And that's the game of course, in the site we sit on, of financial repression. Who's getting, in order to bail out debtors and everybody who hangs with them, somebody will pay the piper. And again, in the little ditty of Russell Long, the chairman of the Senate Finance Committee for longer than I care to remember, don't tax him, don't tax me, tax the one behind the tree. Well, bondholders and people dealing with banks and finance companies, insurance companies, they're the ones behind the tree, and they're the ones paying the piper until there's some change here.
And just a final question, overall, your perspective, Peter, on the global economy, given all the challenges of rolling lockdowns with the virus going forth, say, over the next 12 months, where do you see the risks and any suggested solutions or approaches that you would recommend?
Well, I think we're going to get some vaccine news sometime in October, November. And so I think that will give us a good sense of what 2021 will be like, in the sense of if there's something workable within the next month or two, then you can be confident that will be mass inoculation next year, which will obviously be a good thing. And I think that will be a nice lift to the economy, particularly small business, like that small business restaurant, and going to sporting events again, and going to concerts and getting on an airplane with comfort. Now, that said, I don't think it's necessarily going to be this straight line. I think there's going to be, I think when you have such a traumatic effect, a traumatic event that we had, just snap a finger and get a shot and everything goes back to the way it was. I think there is going to be a change of behavior. I think there's going to be a higher savings rate than before. And I also think that from a market perspective, I'm pretty confident that you get a workable vaccine, the 10-year yield is not going to be 66 basis points. It's going to be higher. And that the Fed, who, like I said earlier, should be focusing on the direction of the vaccine and helping to determine monetary policy, that the rise in inflation because of the demand side going to come back next year relative to the supply, that it's not going to be 3 years before they start raising interest rates. And if they choose to stay at zero, then the bond market is going to hike for them. So what may be good for the economy in 2021 and may be good for our life and well-being with the help of the vaccine doesn't necessarily mean that will be good for certain areas of the markets. It may be good for, again, those companies that have pricing power, but a high PE stock, well, that's going to be vulnerable if I'm right on inflation. Therefore, right on higher, longer-term interest rates.
Mm-hmm. And Ira.
Yeah. Again, Peter and I find so much that we agree on, and I think this is the world we sit in. And I just don't see a way around it. I think the dollar has to go lower if they want to, they've laid out their goals. So that's how are they going to get there? And that's the questions that we all need to ask them. How are they going to get there? How, and to do it fast, because don't you want to do this fast? Don't you want to, again, the real question is, and nobody really keeps banging it on them. Why do you want inflation? Why do you want inflation? So at least, admit to why you want it, which is, bottom line is it's the illusion, Irving Fisher and others talked about, the monetary illusion, to wipe out some of or to alleviate, I should not wipe out, but alleviate some of the stress in debt markets. And that's on a global, national and local basis. I mean, and it's compiling, and that's not a good thing. So this is the world we're going to be saddled with. And you could see, it's like each bank just reads the other's statement before they release theirs. I may as well, and I think Peter pointed it out this morning, you may as well be reading the Fed when you read the Bank of England this morning. They're so similar. And before that, the Bank of Japan last night. It's very all similar. But I'll leave you with this, because Powell said it 2 times. He said it, they said it in the statement, and then he said it when he was at the press conference. And he used this line, and it really caught me. Impede attainment of goals. So they want to alleviate anything that impedes the attainment of goals. Well, that's the thing that scares me the most, because I don't even know what that means. So if a strong dollar or a steady dollar impedes the attainment of your inflation goal, are you going to wipe that out? If a lack of capital expenditures prevents the employment numbers from hitting the area that you want. And again, the employment number is not a hard number. They're looking for, again, what I term to be a social justice outcome, which is that it's not only the jobs should be created, but it has to be jobs going to the people who've really suffered the most here. So that's quite a task to take that you've appointed to yourself. And this is what's going to make the financial landscape so difficult. Well, the Fed says 3 years. I remembered when Bernanke was going to remove it through the taper tantrum in May of 2013, and we really didn't get going until the last quarter of 2018 under Powell, and that got pivoted away from very quickly. So the financial landscape is going to be fraught with all kinds of landmines. I urge everybody to be cautious, and really, before you start throwing money at any idea, research it well and make sure that there's really substance to it. And I would warn you also, make sure you're not buying firms loaded up with debt. The Fed may be alleviating some of that, but that's going to only be for so long, because you hear over and over again the concept of the zombie companies. You shouldn't, So this is going to become part of the discussion as we go forward.
Yeah. Well, it's been a great and insightful discussion. How can our listeners learn more about your work, Peter?
They can read my daily writings at bookreport.com, BOOCK report.com. And if they're interested in any wealth management, they can check out our website at bleakley.com and reach out to me.
Yes, and Ira?
Back to writing a little bit. I did notes from underground, and I will be doing more. And I will have, and I do have a website built up where you can go access. If you go to iraharris.com, you'll find it, and you can access a whole archive of things. But before we just sign off, I just did a little work while we're sitting here, and the highs in the soybeans in dollar terms were made at like 1770 back in 2012. And at that same time, it was 30, almost 36 real to a bushel of beans. Well, as we sit here in today's world with the real up where it is, and it's not even at its all-time lows, coast, but we're at 54.5 real to a bushel, all-time highs. So you see the impact of currencies. And if you're not dealing with inflation, then the impact is phenomenal for trade purposes. But for those who throw it out always to trade, I'm skeptical. There are a lot of other variables that go into it. But that's really it. And I really appreciate this time with Peter. It's always a pleasure.
Same here. Always fun.
Well, great. Thank you very much, gentlemen. Thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.